Welcome back to The Real Accountant. Today, let's explore how companies in the real world use profit and cash to assess performance and make decisions. We'll see how the income statement and the cash flow statement provide users of financial reports valuable information to enable them to make better decisions. Firstly, for a healthy business, it's important to both be profitable and to have positive cash flows. Without both of these, a business simply can't survive. We know that a company's profit is a key performance measure. Taking expenses away from revenues gives us an idea of the overall economic value a company has created or lost within a period of time. Just as important as profits is making sure there is enough cash on hand to keep operations running. Having sufficient cash flow means our business has sufficient liquidity. This means we can meet short-term debts as they fall due. We also know that profit and cash flow aren't always equal to each other. As an example, if we make a credit sale, we earn revenue, but there isn't a cash flow until there is a cash receipt from our accounts receivable. Staying profitable and having positive cash flow is one of the many trade-offs that accountants need to consider. If we focus on achieving one too much, the other will likely suffer. Let's see how. A company could increase their cash flow by offering big discounts on the selling price of their inventory. This could see their sales volume increase, and in the short term, cash flows in and makes the cash position of the business look very good. But offering goods at such a discount could mean our gross profit is small or even negative, making it very hard for the business to generate a net profit. If a business can't make a net profit over repeated periods of time, the firm's equity and assets will keep falling, and eventually the firm will collapse. On the other hand, instead of chasing cash flow through cheap sales, a company could look to focus on making profits. A great example here is electronics retailer Dick Smith, which saw real cash flow issues. The company decided to purchase inventory based on rebates from suppliers. This saw higher profits in the short term when rebates were received, but left Dick Smith with inventory that customers did not want to buy. They also tried to expand by opening new stores too fast when they didn't have enough cash to do so. Despite company profits still being reasonable, Dick Smith ultimately didn't have the cash to pay back its loans to its bank. The company collapsed, and over 360 stores across Australia had to close. Now, you can only find Dick Smith stores online. As we can see here, there is often a trade-off within a business between cash flow and profit. This is just another of the many complex and difficult tasks you need to manage as an accountant. Accountants not only need to manage the cash flow and profit of a company, but also need to tell company stakeholders about performance. To do this, we prepare an income statement telling us whether the company has made a profit or loss, and a cash flow statement telling us what cash has flowed in and out of the business. Large publicly listed companies, which trade on the Australian Stock Exchange, spend a massive amount of money every year to prepare these financial statements in their annual reports. The cost of auditing these reports, which is the process of checking that the information in them is correct, can be up to $30 million a year for some Australian businesses. Preparing these reports for large companies is a much more complex and involved process than you might think. Accountants need to collate and summarise massive amounts of information and present it in an easy-to-understand manner. A wide range of judgments and choices need to be made on how to interpret certain accounting rules and how to provide the best possible information for stakeholders both within and external to the business. These stakeholders include groups such as investors, lenders, and government regulators. They use both the cash flow statement and the income statement to paint a more complete picture of the company. This information is key in helping to make decisions like what companies to invest in or who to lend money to, and is vital in the running of our economy. we can see that managing cash and profit is a tough task. Do you think you have what it takes to manage a business? Thanks for joining us. Make sure to like and subscribe for more real-world content, and we'll catch you next time.